SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi webinar on where do banks end and NBFIs begin. In recent years, assets of non-bank financial intermediaries, that is NBFIs, have grown significantly relative to those of banks. SUERF had a workshop on this theme on 20th January in Brussels with the Belgian Financial Forum. What came out, among other things, was that banks and NBFIs can either be viewed as operating in parallel, performing different complementary activities, or as substitutes and competitors, performing quite similar activities. A further theme at this workshop was that banks operate inside and NBFIs outside the parameter of banking regulation, thus creating an uneven playing field and competitive distortions. Banks would then typically call for lighter banking regulation, while supervisors would emphasize the gaps in NBFI's regulation. One approach to solve this tension is to focus regulation on activities rather than institutions to the extent possible. Today, we will hear a third perspective advocated in a paper by Acharya, Nicola Cettorelli, and Bruce Tuckman, namely that NBFI and bank businesses and risks are so interwoven that they are better described as having transformed over time rather than traditional banking business having migrated to NBFIs. These transformations are also a response to regulation and are such that banks remain special as both routine and emergency liquidity providers to NBFIs. It will be very interesting to hear what implications and conclusions Viral and also our panelists will draw from this perspective. Our lecture and the following panel discussion will be moderated by Imène Rahmouni-Rousseau, Director General of Market Operations at the ECB. Imène will introduce our speakers and panelists and moderate the ensuing panel discussion and questions and answers with the audience. Before we start, let me give a warm thank you to Dr. Martin Scheicher, advisor in the Directorate General Horizontal Line Supervision of the Single Supervisory Mechanism at the ECB. And Martin is also a SUERF Fellow. Martin had the idea for this e-lecture and panel discussion. He designed the program and invited our formidable speakers today. Thank you, Martin. Without further ado, let me now hand over to Imène.
Thank you very much, Ernest, and good afternoon to all of you. It's a great pleasure to have three highly distinguished speakers with us today. Viral Acharya, he's our main speaker. He's the CV Starr Professor of Economics in the Department of Finance at NYU Stern School of Business. He was a deputy governor at the Reserve Bank of India from 2017 to 2019. He's a research associate of the NBER, CPR, and ECGI. His primary research interest is in theoretical and empirical analysis of systemic risk in the financial sector, regulation and genesis of this risk in government and policy-induced distortions, an inquiry that cuts across several other strands of research. Among his many important policy affiliations, I want to mention specifically from a European perspective, his membership of the Advisory Scientific Committee of the European Systemic Risk Board, the ESRB, and Viral has a PhD in finance from NYU Stern School of Business. Then Aino Bunge, she is our discussant from the central bank community. She is deputy governor at the Riksbank, the Swedish central bank. And before she joined the board of Riksbank, she was vice president and head of staff at AMF Pension. She also served as Director General for Financial Markets at the Ministry of Finance and Executive Director for Markets, Economic Analysis and Policy at the Swedish FSA. Aino earned her Master in Economics and Master of Laws from Uppsala University, as well as Master of Laws and International Finance from Harvard University. And finally, Doug Elliott is our discussant from the private sector. He is a partner at Oliver Wyman in New York, where he focuses on financial regulation and public policy issues and their implications for the financial sector. Prior to joining Oliver Wyman, he was a fellow in economic studies at the Brookings Institution and also worked as a consultant for the IMF, the World Bank, the Asian Development Bank, and JP Morgan, among others. He has testified multiple times in the US Congress on these issues. Duke graduated from Harvard College and Duke University. Let me now invite Viral to present the key findings from his paper. Viral, over to you.
Thank you so much, Imène, for that kind introduction. And thank you also to Ernest and Martin for inviting me again and again on different themes to speak. It's always a pleasure to engage, and I'm glad we can do this in the modern Zoom format without having to travel all the time. I also want to thank, before I start, Aino and Doug for kindly taking out time to read what we have done and offer their views. Really looking forward to hearing what you have to say. And I need to just add that because this is work with Nicola Cettorelli from Federal Reserve Bank of New York and Bruce Tuckman, but because it's with Nicola in particular, these are our views and do not in any way reflect the views of the New York Fed or the Federal Reserve System or the Board of Governors, etc. Okay, so there's great interest in this topic of non-banks, and it's partly because globally non-banks have surpassed banks in terms of assets that they warehouse on their balance sheets. So let's just say in terms of their balance sheet size. This has been a significant development in the Eurozone. In the United States, non-banks have grown and they continue to grow at a faster pace than banks. Nevertheless, that scenario was already achieved in early 2000s. And as you can see for United States, the only real dip you see there was in the 07-08 crisis when both shadow banks and non-banks failed, but many of them were also consolidated back on the bank balance sheets, sometimes because there were explicit connections in the form of liquidity lines of support from banks to their special purpose vehicles and conduits that had asset-backed commercial paper. And in some cases, when such explicit links were not there, there were still implicit reputational links that forced them to take them back. Post-crisis, my take is that we went heavily at regulating banks, but we sort of didn't do as much on non-banks. And that's sort of going to be our take, that it's not therefore surprising that non-banks are growing as fast. That's sort of really the main message we have. And then the second key point there, however, is the reason I referred to 07-08, because my work for that crisis already showed that even when banks were setting up these conduits, they didn't want to just set them up and be done with it. They had to provide them liquidity support that was crucial for these conduits to get the high rating from the highest commercial paper rating from the credit rating agencies. That was crucial because otherwise money market funds would not fund them. If money market funds would not fund them, then their leverage would not be as cheap. And then perhaps this whole transformation of taking assets, credit card loans, auto loans, corporate receivables, MBS, from the bank balance sheets and temporarily warehousing them in the non-banks with the idea of perhaps through a liquidity support getting them back, or even if they didn't visualize that, at least temporarily giving them a liquidity support so that the cost of non-banks would be lower in this regard, was very much at the center of what happened, besides, of course, the fact that there was underwriting of terrible mortgages in the build-up prior. So that sort of already in some ways challenges this parallel view. The parallel view, I wouldn't say it's the predominant view, but it's dominant enough that it comes back and keeps biting at how we think about banks and NBFIs. Of course, in the 1930s, that view was at the center of uh, you know, Senator Glass's proposal to separate investment banking from commercial banking. The view was that banks should focus on deposits, loans, and payments. Non-banks should focus on capital markets, and that there is no reason to really blend these activities. And if you look at the hearings prior to the Glass-Steagall separation, actually the bankers, either for lobbying reasons or because they had the right economic view, were always saying that no, a bank should be a supermarket of financial services, that banks have tremendous synergies in moving money and payments across various lines of business. There are information overflows and synergies across various lines of business, etc. Nevertheless, you can see that when the 07-08 crisis occurred, the take on it was that, oh, we need to protect the banking system from the non-banking malaise, and that let's try and separate banks from prop trading, hedge funds, asset management, or at least increase the costs of them doing so. And unsurprisingly, since 2013, Nicola Cettorelli and Saket Parzad have a paper which shows that once the living wills and other paraphernalia of Dodd-Frank Act was put in place, a lot of non-bank activity left the banking perimeter. Bank holding companies that were housing non-bank subsidiaries chose to let these subsidiaries go rather than put up the extra capital that the Dodd-Frank Act was asking them to put up, and the implicit complexity tax that the living wills were imposing on them. So, of course, we repealed Glass-Steagall precisely because the separation was untenable in an international setting where US banks remained separate, foreign universal banks were not separated, and yet there was sort of global flow of money and capital post the collapse of Bretton Woods. I think the more popular view and the more, I would say, the more prevalent view is the substitution view, which is closer to the view that we have, which is that, oh, banks can do X, so can non-banks, but banks are regulated, non-banks are not. So unless the rules are harmonized, activity moves because of regulatory arbitrage from banks to non-banks. Under substitution view, the reason why I think it's important that we think about that is because it says that activities that banks would have done are now migrating to non-banks. So unlike the parallel view that takes deposits, loans, and payments as systemically important, under the substitution view, non-banks can be systemically important because they are simply taking over banking activities because they have weaker rules and capital to hold against them. And I think this is a key point. Clearly, runs are very damaging, and they can be in the form of panics. So very salient. They can destroy confidence and trust in the financial system as a whole. But we have started supporting non-banks en masse. We have realized that non-banks, if they are significant providers of capital to an important part of the economy, that their weaknesses can also create spillovers to the real economy. And so for the same reason that we want to stabilize banks when runs occur, we have started stabilizing non-banks when their redemptions occur or when their cost of capital becomes too high because of some market dysfunction that prevents them from intermediating to an important part of the economy. Once you recognize this, you kind of appreciate that non-banks can be systemically important if they are beginning to play a significant role for intermediation activity to the real economy. Now, the reason why this is crucial is because ultimately when I talk about policy, it's going to be important whether you approach it via banks, via non-banks, and what the various options might be. Now, the transformation view that we have is a bit closer to the substitution view, but with this important dimension that just because banks are regulated more than non-banks doesn't mean that when activity flows out to non-banks and assets that are originated are no longer being warehoused at banks, but they are on non-bank balance sheets, that banks are out of the picture. We're going to argue that banks are always the repositories of the economy's liquid savings. By liquid savings, I mean deposits. And they are also the economy's repositories of contingent liquidity, because commercial banks are the ones who, by and large, in most jurisdictions, are the designated entities to have access to the central bank reserves, either through open market operations, through intraday facilities, or through specialized lenders of last resort facilities. What this means is that banks basically have a liquidity advantage relative to everyone else in the economy. They get fast-moving liquidity in and out of balance sheet through deposits. As I have discussed, runs are precisely a problem because they can have access to fast-moving liquidity outflows as well. Nevertheless, as long as the banking system is stable, liquidity seems to lubricate the economy through the banking system. And this means that even when banks and non-banks start separating themselves as far as asset warehousing is concerned, there's going to be this liquidity connector, like an umbilical cord of sorts, from banks to non-banks, so that every time non-banks need liquidity on the fly, contingent liquidity, they are going to be coming to the banks. To put just this in a very stark way, just because asset origination and warehousing moves from banks to non-banks, deposits don't move from banks to non-banks. Deposits remain in the banking system. So funding has to find some way out. Now, of course, non-banks can access bonds, they can access money market funds, they can access some other sources of finance. But what we find is that even on balance sheet funding, not just contingent funding, NBFIs seem to be dependent on banks. And that's really the transformation view, that banks will find that banks and non-banks are really in a symbiotic relationship. The system as a whole is trying to optimize on its leverage. Inside the financial system, they call it capital efficiency. In the regulatory space, we would call it regulatory arbitrage. But that's what the system as a whole is doing. But on liquidity, banks remain the primary and the efficient providers, and that's going to imply these umbilical cords from banks to non-banks wherever we observe them. So to just make it precise, so the transformation view is akin to the substitution view, that non-banks emerge to loosen regulatory constraints and to reduce regulatory costs. But the transformation view has this sort of additional wrinkle in it, which is that all of this will, however, happen while trying to harness the funding and liquidity advantages of bank deposit franchises and access to safety nets. Okay, so to just give a historical perspective on these transformations, I think perhaps the first of these lots were for loans and mortgages. They happened over a period of time, maybe notably since 70s. And this was already documented in the literature, notably by Boyd and Gertler, that historically banks used to hold loans and mortgages. Now they don't. The originations, even if they happen to banks, they are explicitly with the purpose of syndicating them out to non-banks such as CLOs. Mortgages are not even now being originated by banks. They are being heavily originated by non-banks. Nevertheless, if you observe the structure of, say, CLOs that hold corporate loans, which are now traded in the secondary market, you observe that banks make them senior loans. Banks give them credit lines or warehouse lines for them to originate, warehouse before the syndication is complete. And of course, we know from the 07-08 crisis that banks didn't just securitize mortgages, they actually bought back mortgage-backed securities back on their balance sheets, which was basically sort of saying that, they just cherry-picked the capital requirement that they wanted to pick on the risk weighting scale of the Basel capital requirements. The sort of 80s, 90s transformations then gradually took the form of short-term funding provisions. Some of this was already there in 1970s, especially the flourishing of commercial paper. On the one hand, an NBFI or even a real economy corporation issuing commercial paper looks like, oh, they are now funding themselves from non-banks, but not quite entirely, because every commercial paper that gets written usually has an 80% backup line of credit from a bank. The reason is because without that liquidity guarantee, the rating agencies won't give commercial paper the rating that will make it attractive for money market funds to hold the commercial paper in this place. But this is a much deeper phenomenon. You take a hedge fund needs to trade day in, day out. They don't go back to their principles for every trading transaction that they need to do. How do they manage liquidity on the fly? They have a prime brokerage facility from a bank, typically a large bank, and then they manage a portfolio of their liquidity needs through that. Take mutual funds. Mutual funds, if they were to sit on cash in order to meet their redemption needs, they would throw their benchmarking completely off the whack. So what do they prefer to do? They say, let's not hold cash. Why don't we get a credit line from a corporation, from a bank? That's a much better way to stick to our benchmark and then draw down the contingent liquidity that we want. Take private equity, private credit. They all need to originate deals. They need to originate underwriting and support it. How do they do it? They basically have standby letters of credit when the deals are happening, or they have subscription lines which are backed against the subscriptions that their principal investors will make. But it's not the principals who provide them liquidity on the fly. It's banks that provide them liquidity on the fly, and then these private credit and private equity will rebalance their capital structures over time, repaying the lines that they have drawn down. And the new modern post-GFC version of this is where now banks seemingly got separated from derivatives activity, because earlier they used to be counterparties in derivatives transactions, doing portfolio margining for their clients. We said, no, that's risky for banks to do. Let's put it all on a CCP or an exchange. And then the exchange will do the management of credit risk, effectively converting credit risk into liquidity risk through over the cycle margining, demanding higher initial margins, marking to market and demanding variation margins, etc. Seemingly, we have taken banks out of the picture, but not quite. How do the non-banks who deal in derivatives get the liquidity to post the margins? They have lines of credit that are specifically designed to help them meet their initial and variation margins. When the UK gilt crisis happened in September and October 2022, pension funds, non-banks, had exposure via the interest rate swaps market to these margin calls. Where did they go first? They went to the banks that were going to provide them liquidity, and banks after a point said, listen, you need to either shore up more collateral or get more equity, otherwise I can't keep giving you contingent liquidity. So even in the transformations where we think we are taking out banks, banks are sitting at the back in providing liquidity for the precise risk management that CCPs and exchanges are trying to achieve through their superior margining. It could be that this arrangement is better than what we had before, but the point is that banks will remain connected to these non-banks in one way or the other. Okay, so let me just quickly explain a schematic. This is something we have been working on only very recently, but I just wanted to make a couple of things precise by explaining this schematic. So think about an original asset R that banks used to hold, but now under the transformation, it moves to the NBFI. So the asset is now sitting on the NBFI balance sheet. The NBFI in its capital structure has a tranche, which is of 1 minus S of its capital structure, and that S is then the NBFI's own capital. Let's call it equity, but it can be bonds or commercial paper, something that is raised through non-bank sources. 1 minus S is raised from banks. What are banks then left with? Banks are left with owning this tranche of the NBFI. But on banks' capital structure, there's deposits, and then there's banks' own equity. Okay, and the key observation is that if you make the simplistic assumption that deposits are basically going at a convenience yield relative to other costs of borrowing in fixed income markets, I think that's a reasonably well-documented fact in finance now, that deposits carry a convenience yield of their own. except perhaps when banks are about to fail in the first place. Then banks basically, in that extreme view, in the simplistic static view, banks basically don't want to hold equity. Okay, banks want to fund everything with their deposits if they can. Why? Because it's a subsidized cost of financing in the economy. Why are deposits subsidized? Maybe as a depositor, I'm sleepy. Maybe there is a backstop, deposit insurance, backstop from the Fed. I don't want to get into that sort of important discussion, but the key point is that banks will hold equity only to the extent that bank capital requirements are asking them to hold some equity at the junior level in their capital structure. So now what this does is that banks are trying to optimize on their capital requirement. They want to bring it down as much as possible. So they want to send assets out to the NBFI sector. Now, what's the problem? The problem is NBFIs, of course, face a higher cost of capital than banks do because they don't have access to deposits. Okay, so that's why that subordination tranche S is costing something above the risk-free rate, whereas bank deposits are costing something potentially below the risk-free rate. Okay, so now what's the problem? The problem is NBFIs will want to be compensated for this. So when banks fund them with a tranche, they will say, no, 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 I can't give you the entire asset R return. I have to at least keep for myself what is my cost of capital. Maybe they even charge some other costs of intermediation, etc. So now the optimization problem for the bank is that when they send assets over to non-banks, they cannot keep the full return of the assets. They have to pay the NBFIs for their cost of capital and intermediation costs. So now they are left with a return on the tranche, which is R minus the NBFI cost of capital. And what are they going to compare that with? They're going to compare that with, okay, for this tranche 1 minus S, what is now my regulatory capital requirement? Okay, so that problem basically starts looking something like this, which is the red line over here. On the x-axis is the level of subordination. So the higher is the subordination, the bigger is the size of the non-banking system, okay? Because banks are holding smaller and smaller pieces of the capital structures on the originated assets of the economy. Okay, on the y-axis is the bank payoff. So what does the bank payoff consist of? On the one hand is the red line, which is the bank return on the tranche, which is that the higher is the subordination, the more of the return are they giving up to the non-banking system because they need to earn their cost of capital. And then the purple line shows sort of like a generic regulatory risk weight implied bank cost of capital for holding the tranche. The greater is the subordination, the smaller is the bank tranche, 1 minus S, and therefore the capital requirements are going down. The gap between these two lines is the profit that the banks make from doing the regulatory arbitrage. What do they want to do? They want to maximize the gap between the red line and the cost of capital. So you can see that where I've drawn the vertical red line, that's the optimal transformation over here. If cost of capital for non-banks increases, the red line starts moving down, and basically transformations will all go back onto the bank balance sheets. If cost of capital of banks becomes lower, because we are in easy money times, transformations will start moving towards the right and non-bank system will grow. If regulatory costs of capital rise, then basically this purple line starts shifting down and towards the right. And as a result, the red vertical line starts moving to the right and non-banking system expands. Okay, this is sort of the very, very simplistic view of the transformation. The additional wrinkle in what we have is that there is a bit of a circularity now, which is that banks can actually affect the non-bank cost of capital by giving them credit lines. So think about what I said about commercial paper or asset-backed commercial paper. By giving credit lines to non-banks, banks are effectively taking some risks back, and they are doing it because somehow there is some distortion in the cost of capital. Maybe the money market funds can only invest in the prime commercial paper, prime rated commercial paper. So banks are also facilitating a reduction in the NBFI cost of capital so that the overall leverage in the system is optimized. Let me go through a couple of very, very quick examples. I think I've already explained the private credit and the pension fund examples, but just to summarize them very quickly, some salient examples: when PacWest around the 2023 SVB stress, was trying to get rid of its account receivable loans. Seemingly, they got acquired by Ares Management, a large private fund. But of course, the deal was structured through financing by Barclays. If you look at Blackstone's private credit fund, the largest private credit fund out there with $50 billion of assets, it has committed facilities at any point of time of $23.5 billion, and almost all of them are provided by 13 banks. Typically, about 50% of that is always drawn down at any given point of time. Of course, there are other things in their capital structure, like bonds coming from insurance companies and so on. On the right-hand side, you see the transformation where banks are now sitting on the back after the margining is being done by the CCP. So historically, a pension fund would have gotten an interest rate swap from a bank. That's partly because they are short of long-term safe assets because of QE and things like that. Now they go to LCH Clearnet or a clearing house like that. The clearing house is doing margining for them, but ultimately that margin calls are being made by pension fund through loans and credit lines. And you had a classic intersection of solvency and liquidity problem on the pension funds at the time of the gilt crisis, because banks said, no, I will not give you any further credit line or extension of facility to post margins unless you shore up more equity from your savers. And that's what the UK pension funds had to do by taking time for 2 weeks. And you could argue that what Bank of England did by stabilizing the gilt markets was to give time to the pension funds to actually rebalance their capital structures the way banks wanted them to do it for posting any further liquidity out there. Okay, let me now just spend a little bit of time in the last part of the talk on credit lines. I want to stress that credit lines are becoming quite important, even though term loans to non-banks are also important. So here you see that as banks have grown since the Dodd-Frank Act, as non-banks have grown since the Dodd-Frank Act, so has the share of bank intermediation that now consists of credit to non-banks. On the left-hand side, you see that share of term loans to non-banks as a share of total loans that banks make has grown from 10% to over 25%. If you look at unused commitments, they are now also as large as 20%. In terms of magnitudes, term loans is about, let's say, out of $1.2 trillion, $300 billion of term loans is to non-banks. In case of unused commitments, out of $7.5 trillion, about out of $6 trillion of credit lines, $1.5 trillion of credit lines are to non-banks. Okay, so these are large numbers: $300 billion of term loans, $1.5 trillion of credit lines from the banking system to the non-banking system as a whole. Okay, I won't go into this table because I want to focus a little bit more on credit lines. But what you see is that if you look at the matrix of dependencies through this from whom to whom table that is now possible with the flow of funds data that US has put together, what you find is that liabilities of banks, which are in the horizontal row, are not held much by any individual non-bank category. Mostly banks are funded 62% by the real sector. That's basically saying a lot of it is just deposits. There are some deposits that get clubbed into rest of the world. They might be foreign deposits. In contrast, if you look at the bank column at the left-hand side, you can see that banks are providing 10% of liabilities to ABS issuers, 25% to broker-dealers, 25% to equity REITs, 15% to finance companies, 8% to mortgage REITs, etc. And of course, there are some other larger players like life insurance companies, etc., who are also pensions, etc., who are funding some other non-banks as well. But broadly, the picture you get from this from whom to whom flow of funds matrix is that the real savings of the economy are in the form of deposits, insurance premia, and pension fund savings. These are the three largest. Maybe you can add money market funds there as a fourth category. All of the other intermediaries are then trying to synthesize financing from these primary real savings of the economy, from banks, from insurance, from pension, from money market funds, etc. This is not to say that insurance companies and pension funds haven't played a crucial role in the growth of non-banks over the last 15 years, but that banks remain crucial providers. Now, the key point of this from whom to whom matrix is that it is only the on-balance sheet liabilities. The undrawn commitments don't show up in the flow of funds. Only the drawn part of the commitments shows up in the flow of funds. Okay, and this is important because what you are observing increasingly over time is that banks and non-banks have become interconnected. So here we look at a measure of S risk, which is a measure of expected capital short of banks and non-banks. And what we are finding through the NYU VLab work is that rather than substitution having caused banks and non-banks to become separate, actually banks and non-banks are co-moving much more than they used to historically. Okay, so pre-GFC, the correlation used to be 0.65. Post-GFC, it has swung decisively in the range of 0.8 to 0.9. Sometimes banks are causing NBFI systemic risk to rise. Sometimes NBFIs are causing bank systemic risk to rise. And so to just explain this very quickly, one example of this is the equity REITs. This is an important asset class because REITs hold a lot of commercial real estate, which is a struggling asset class in the office space, even though it might be doing very well in the warehouse space. And what you find is that non-banks drawdown of bank credit line tends to be higher on average than of real corporations. Okay, so let me just explain what this plot is. This will be the last point I want to make. On the x-axis is a quarterly S&P 500 return. So when you are on the left-hand side of this axis, that's a more stressed quarter. When you are on the right-hand side, that's a relatively booming or a calm quarter. And on the y-axis, you have the quarterly utilization of bank credit lines separated between the green line, which is for non-financial, so the real corporations, the red line, which is the financials other than the equity REITs, and then the blue line at the top, which is the equity REITs. Okay, and so what you see is that non-banks are a little bit like small businesses. They keep utilizing bank credit lines all the time, like working capital. 20 to 25% drawdowns even in a regular booming quarter. In fact, in a booming quarter, more market activity might be happening in terms of originations, underwriting, etc., or trading volumes, M&A, etc. And therefore, non-banks, like working capital users, they actually keep drawing down more on bank balance sheets. But you see here a very steep increase in the drawdowns of the REITs, especially as things go down. So when things get stressed, they draw down very heavily on their on the credit lines. Of course, commercial real estate is very exposed to the economic cycle period, even prior to the recent downturn of the office space that you've had. If you see this, you can see that the risks do travel back to the banks. Okay, so at the time of the 07-08 crisis, also when commercial real estate got into trouble, banks that are more exposed to credit lines to these equity REITs suffered disproportionately more by as much as 10 to 20% of their stock returns relative to those who had less exposure to these credit line drawdowns. And that's because when the market performs poorly, the REIT drawdowns increase as a stress scenario drawdown quite substantially. This was true even at the time of COVID. And in fact, if I can show you the COVID quarter here, it's at the peak here. If you look at the 50% utilization rate on y-axis and go horizontally, you can see 2020 Q1 had 50% utilization of bank credit lines by the equity REITs. And unsurprisingly, in 2020 Q1, banks that were exposed heavily to REIT credit lines had about 7.5% worse exposure, worse performance in the stock market compared to others. Okay, so let me wrap up. I think what we are trying to say is that banks and non-banks seem always connected, even when non-banks are growing, perhaps because regulatory frictions have increased or non-bank cost of capital is low. Banks continue to be on the capital structure through term loans, and more importantly, through contingent credit lines in the form of liquidity support. So at a minimum, I would say, whether this is efficient or not, it says that in stress scenario, risks could travel from non-banks back to the banks, both via credit lines and perhaps even via term loans if solvency becomes an issue as well for some non-banks. Maybe it's not as big an issue now. It was in 07 and 08 when they were much more thinly capitalized. So at a minimum, we need to holistically monitor and supervise the entire banking system. And of course, this is a proposal that has been made in a number of regulatory reports. The key question then is somehow this risk of bank and non-bank correlation mispriced in the system? All theory seems to suggest it would be, because there would be fire sale externalities when all these things happen. So once REITs draw down on banks, if some banks are becoming tight in their market conditions, they will then pull back, say, their credit lines to hedge funds or pull back their credit lines to small businesses. And all of this is not going to be internalized. The real spillovers that occur are not a matter of the pricing of every individual credit line, which may just get priced actuarially fair, but it may not be reflecting the systemic spillovers that happen in the stress scenarios. So what are the options? There are, I think, two different options. One is to say, okay, let's improve the regulation of bank liquidity provision to non-banks. Just recently, I saw that Federal Reserve's new stress scenarios, while dampened overall, they are suggesting that these non-bank drawdowns in stress scenarios should be paid particular attention to. So one way is to say, okay, we're going to look at these connections purely through the banking system, tighten the regulation on banks. Banks will then raise the cost of capital of liquidity provision to non-banks, and maybe we get some stabilization of these externalities. Another option is to say, if non-banks have a risk of redemptions, they have a risk of cyclical drying up of their capital, which causes the spillovers to banks and perhaps also to their borrowers. Why don't we get them to pre-position liquidity the way we are asking banks to do it if they have demandable claims? Okay, so this would be like Mervyn King's pawnbroker for all seasons proposal, saying anyone who has a redemption claim should actually be pre-positioning liquidity. Of course, the idea there is that perhaps we are implicitly saying that that pre-position collateral will be lent against by the central bank anyways. And so why don't we actually get a sense of liquidity risk that's out there by doing this pre-positioning? In my view, regardless of how we do all this, it may not be enough. So my preference has always been that ex post, if the regulators end up providing emergency liquidity to some non-banks or parts of the non-banking system, at least from that point onwards, which is once they have received LOLR, I think the recognition should be that that part of the system is systemically important. And maybe the best thing to do then is to actually start regulating them. So either you say, because I can't regulate them, I'm not going to provide liquidity. Let it be a fiscal decision how to bail out that part of the system. Or the central banks or the liquidity providers should say, listen, if we provide them liquidity, they are systemically important, give us the supervisory powers to deal with them. Okay, why don't I stop here? I look forward to hearing the panelists and then responding at some point in this time. Thanks so much.
Thank you very much, Viral, for a really fascinating presentation. I mean, you put the financial sector here under the microscope to highlight this changing interconnectedness between banks and NBFIs after the GFC. We're going to now start the discussion with Aino and Dirk, and we'll have 3 thematic rounds of discussions. So I'd like to start with the first question to both of you, Aino and Dirk, which is really drawing from the concepts that Viral exposed. How do you think about the difference between the substitution view between banks and NBFI and the transformation view? I mean, how different are these two views, and where do you position yourself between these two views?
Thank you so much. And first of all, thank you, Viral, for a really interesting presentation and a very interesting underlying paper. I think it really illustrates how we're moving to an ever more complicated financial landscape, and certainly will have challenges to keep up with this development in terms of both systemic risk, supervision, and regulation. And this evidence of increased role of non-bank financial intermediate, I mean, it's the same development that we see all over the globe. It's the US, the Europe, and in my home country, Sweden. And it's, of course, very interesting to see how you use new data to show these increased liabilities. On this, I see that there's a new view then on NBFIs on bank, the transformation view that really stresses interconnectedness and the linkages. I like this expression of the umbilical cord of liquidity that is still held towards banks. But I guess it can be described as an evolution from the view where you view these parallel activities to the view of substitute and regulation of banks, leading to some more activities being performed by NBFI to this transformation view. But I would like to make 2 points. I mean, first, I think when we look at the growth of the NBFI sector, I think it's really important to think about that it's a really heterogeneous group, and this is the case both in the US but also in Europe and other, and it includes everything from insurance companies to investment funds to money market funds and family offices, rates, private credit companies, etc. So it's a quite a diverse group of companies, and if you talk to the general public, sometimes if you say it's a non-bank, they look at you kind of strangely because they think there must be some more precise definition of this, and I think Doug may come back to this. But it means that I think that sometimes these three views on NBFI may actually coexist depending on what part of the sector that you are looking at. But looking specifically then secondly on this transformation view, I think both the transformation view and substitution view, as was pointed out by Viral, they rely on regulatory arbitrage, and they both admit the systemic importance of NBFI in that they may take systemically important roles and they may thus be rescued by authorities. It concludes that you could have increased systemic risks by the NBFI development, and you need to have supervision of a broader set of actors. Substitution view speaks more of the regulation of NBFIs, even if you do that also for transformation. But transformation, it really points for this measuring, monitoring, and looking at the linkages and trying to internalize the externalities of the NBFIs and their links with banks. But I guess if you're even in the substitution view, if you're going to regulate the non-banks and try to separate this, you need at least some way of monitoring and measuring risk. So maybe it's more of like a transformation than two completely different views. And I guess even from the global financial crisis, as was pointing out, I mean, securitization it's a prime example of increased exposures to banks when you saw that these financial institutions did really not follow the sort of business model of securitization and not transferring risk to mortgage lenders by keeping some of the risk of themselves. And then the skin in the game could also be in the form of credit lines and liquidity. So I think this is it's really important new way of looking at the NBFI sector, but I think you also need to look at, when you look at the sort of sector in itself, you need to differentiate between different actors within the system. So I'll stop there for this first round.
Okay, thank you. And first, let me thank our hosts for inviting me, and thank Viral and his co-authors for the excellent and thought-provoking paper. And I'm going to use shorthand, by the way, and just call this Viral's paper, even though I know he has co-authors because I've known him a long time, and it's just easier. So for those of you who don't know me, I focus broadly on the intersection of finance and public policy. So I get to cover a very wide range of issues. NBFIs have been particularly interesting of late, and so I put a lot of time into that and the relationship between NBFIs and banks. I co-authored a paper in the fall that's available on the Oliver Wyman website on rewiring the financial system that examines the evolution of the corporate credit sector in the US, where a lot of this change is happening with banks and non-banks. I refer you to that partly because our views overlap pretty heavily with Viral's, though there are some differences. And as we get into some of the policy implications, we might have fairly different views on this. But before I go further, let me just associate myself with Aino's point, which is I understand why we talk about non-bank financial institutions, but it's an extremely unsatisfying term. I sometimes compare it to if we were to divide manufacturing into auto manufacturing and non-auto manufacturing. Now, maybe that's a helpful distinction in some ways, but it lumps together this very heterogeneous set of activities. Aino was mentioning some of those. Look, we have some that basically are banks without a bank charter, and they really are very similar to banks. And for that, the substitution approach has particular relevance. There are insurers, and insurers are significant investors in credit and have ties with the banks, but they also have just quite different business models than banks do, and that plays out in a number of important ways. There are NBFIs that are funds, and their underlying investors can have a very wide range of attributes. And then Viral didn't have a chance to mention it, but in the paper, in his paper, there's a discussion of electricity companies at one point. And if you start lumping private non-financial corporations in with NBFI because they sometimes have significant financial exposures, you widen this out still further and make it hard to reach general conclusions. That said, though, I agree with Aino that Viral's paper is a very useful contribution to the field. And the transformation view in particular, I think, is a really useful way to look at this. Now, no one lens ever gives you the whole picture. Just like a metaphor or an analogy, it focuses you on certain parts and can be very useful analytically, but it moves you away from some other parts. So it's always a matter of emphasis. But he and his co-authors have made a really strong argument that we agree with in the paper I co-authored, that there's been a fairly dramatic transformation, certainly in corporate credit where I was looking. And this transformation involves a great deal of interconnections between the banks and the non-banks. And particularly, what's happened, as you'd expect, is each type of organization migrates to the part where they have a relative advantage. And for the banks, their ability to provide contingent credit and to have cheap funding for that is an important advantage. One thing he didn't have a chance to emphasize in his remarks is generally in a crisis, money flows to banks as a whole, not away from them. Individual banks may suffer, but banks as a whole tend to have an inflow of liquidity, which puts them in the exact opposite position of almost everybody else, which is one reason they're in some ways ideal providers of the contingent funding. So I will just mention one other thing, which is, I think one implication of all that we've looked at, and particularly Viral's emphasis, I'd even argue perhaps overemphasis on the regulatory arbitrage that's driving a lot of the change, is as we see in the US a likely swing of the pendulum towards lighter regulation on banks than where we've been, I think the relative advantage of non-banks is going to decrease. And I think you may see something closer to the substitution approach, where more of the traditional business like direct lending moves back towards banks. It'll be interesting to see whether the momentum of the change that we've been observing and that Viral has described so well, whether that and the underlying forces behind it overwhelm the change in the regulatory pendulum or not. And I certainly don't know. I'll stop there.
Thanks a lot, Aino and Doug, for these really, I would say, insightful comments. Viral, do you want to react to any of these?
No, thank you, Aino and Doug. Yeah, I think I tend to agree with the view that, one reason why we haven't pushed the regulatory arbitrage view, even though Doug said it very strong, we wanted to push it even stronger, But the reason why we haven't is because the arbitrage is so complex on each particular NBFI that when you piece together all its pieces, because now there's so many, earlier in 2000, there used to be like one simple capital regulation. Now there's a liquidity regulation, there's a living will, there's some other implications, etc. And so we did actually make an effort on in that table on transformations, on loans and mortgages, then the short-term funding and contingent funding. At some point for each of the examples there, we were trying to piece together the full complexity of the regulatory arbitrage that's there. And you realize it's a losing game because, you can't get it right. You think you've got it right, you present it, and someone in the industry points out, oh, this is not how it works. There's like one small important detail here that you missed altogether. So I think what it shows is that the modern financial system is like very complex, it's very heterogeneous. And I think even in that from whom to whom table, it's very clear that there are credit-like intermediaries who seem more dependent on the banking system, whereas there are market-style intermediaries like mutual funds, etc., who seem more dependent on pension funds. The insurance companies seem to be a little bit sort of everywhere because I think they are maybe a bit hybrid because some of them do try to do annuities and then it starts looking a little bit like a redeemable claim, whereas the pension claims are a little bit more truly long-term asset. I want to stress on one point that perhaps I think both Aino, but especially Doug stressed, which is that money flows to banks during difficult times. And actually, if you look at the theory of banking from a credit line perspective, that is actually the core of the theory, that the reason why banks can provide credit lines, and mostly no one else does, is because when the corporate demand for credit comes, it's not going to be perfectly correlated with a household's demand for consumption. And if anything, households may be becoming extremely risk averse at a time of crisis when the corporate demand for credit lines is going to come up. So unless the bank has mismanaged its own capital structure, which happened at the time of 07-08, which is that instead of banks becoming providers of liquidity to the rest of the world, they were actually withdrawing liquidity from everyone at the peak of the shock. So in a way, banks failed in 07-08 as being the automatic stabilizer. And I think therefore we had such a bad outcome for the global economy. But even during COVID, actually, they were gushing in with deposits. And, as long as the macro uncertainty was reduced, they were then able to sort of restart intermediation. No, so I tend to agree with the panelists. I think what I would say is that I think we have perhaps exaggerated, I think, to an extent, this umbilical cord, as I called it today. And it's partly because we just want to get attention of the umbilical cord to the places where it's still around. But I fully agree that not all parts of the non-bank system look like they maintain such a strong cord to the banking system.
Now we'll turn our attention to our second round of discussion, where we'll go deeper into specific aspects related to financial stability, but also some of the market-based intermediation aspects. Yeah. So I know you've been actively involved for many years in the policy work on financial stability regarding NBFIs. So, what are your views on how the debate on the financial stability implications of the role of NBFIs in the financial system has evolved? Are we able to better understand and manage the systemic risks that might be coming from NBFIs and their interconnections with banks? And more specifically, one question is that, from my perspective, when I look at the market events, the recent market events where NBFIs were involved, I see that one of the channels by which this systemic risk manifests itself is large-scale liquidation of assets that are held by NBFIs. And that's the case for the 2020 dash for cash. That's the case for the UK LDI crisis. And when that happens, of course, the I don't know if I should call it the umbilical cord on the market side, but like the conduit that becomes very strained and constrained is bank dealer intermediation. Okay, because in a way, the size of these large-scale liquidations by non-banks cannot be accommodated by dealer capacity. So, very much interested into how you see these debates evolving, and Doug, I mean, you summarize the thrust of your paper on the corporate credit sector in the US, and I was really interested to know if you think that this evolution on corporate credit has, and especially private debt, okay, the private debt are part of it, whether you would see it playing out in the same way in Europe in the coming years, or whether you see differences on how this private debt can play out between the US and Europe. So, I know, please.
Well, thank you. So I think, first of all, I think this whole debate is a great reminder that we really need to have a broad horizon, and it's going to be a complex assessment of risk if we're looking at the systemic risk in the system. And I would certainly agree with Viral that we've done more on the banking side than the NBFI. If you look at real actual regulation in terms of systemic risk. I think that more analysis, I mean, that's definitely, we're trying to look at data and the interlinkages, but just as to sort of summarize the regulatory arbitrage going on, this is quite difficult. And we're facing the challenge that even if we're trying to get a holistic view of systemic risk and how liquidity, et cetera, would move in the system, we do face a current regulatory landscape that is entity based. It depends on national borders and jurisdiction, and we're not gonna be able to change that. So I think that a lot of the work now doing is to, at least you need to have this activity based approach to risk identification and assessment, and look at regulation from a more holistic perspective. And I think there's heightened supervision. I mean, those initiatives are on its way in the US and in Europe, and you're trying to have this congruence principle where similar activities should be regulated similarly, but the interlinkages still need to be taken into account. And I think that in Europe, we're now in the process, we still have a very banking-based system in Europe, and we've seen all of these initiatives like the Savings and Investments Union, where we're trying to move to a more market-based finance. And I think it's really important in terms of regulation and supervision that we actually sort of move that along the same way. But as we're pointing out the risks, I think there are also benefits, because of course connecting long-term pension savings with the need for long-term investments in infrastructure and in liquid assets, that's a good thing. And I mean, if you're saving for your retirement, I don't think that the bank account is the best way to get a good pension in the end. So there's clearly a potential here, but I think this shows that you need to deal with this complexity. And I think one way of, like you're saying, these events where you could see assets being sold, etc., looking at systemic stress testing technologies and see how we can move that forward, improve data sharing between authorities. But I mean, it is a challenge when we see bank intermediation, but of course I think you have to I mean, that's one of the things that we have to think about. Well, what are we more concerned about? I mean, market liquidity in good times may be really good, but we saw that during the times of stress, I mean, banks actually withdraw their liquidity also in earlier aspects. So it's good. I mean, you need to have this a market functioning both in good times but also during stress periods. But I think it's a challenge. And I also think, I mean, talking about regulation in itself, I'm certainly not proposing to lower banking regulation. I think that's looking at the past crisis, both the COVID and actually the increase in interest rates, we can see there were clear benefits in having strong banking regulation in an economic downturn. But there are challenges with regulation. So I think we have to sort of look, if it becomes overly complex, then we perhaps cannot really view the results of it as well. And here, of course, the problem that comes in are this, that some of these NBFIs are truly global actors, and something that we might come back to is that, I mean, there's a challenge to global cooperation right now. So I think that might, it's also difficult. But definitely, I think this is a strong urge, at least for us, to do more holistic analysis and looking at this from a system perspective.
Thank you. And I mean, you were asking about the potential for this growth in Europe. Look, I certainly do think there's the potential there, though Europe's a very different environment with quite different regulation, different market structures, and Europe isn't really Europe anyway. We aren't remotely close to a capital markets union or a savings and investment union yet. But as you look out more generally at the future of this sector, there really are some questions. So first of all, on the systemic risk side, I'm in what I think is the broad consensus, which is that the current state of development, there's not big systemic risk coming out of the NBFIs. Now, maybe Viral, when he gets his shot, will disagree with me. But much more of the concern when I talk to central bank governors and others is about the direction and the changes that are occurring. Before I get into that, one thing I do want to be clear about, and Aino's mentioned it as well, which is elements of the transformation that has occurred and are continuing are natural, they're positive, they're propelled by forces like we haven't talked about, but just improved access to information and analysis. It used to be banks were completely dominant in credit because you had to get a huge amount of private information and analyze it. It was expensive, and there were economies of scale in a bank dealing with a borrower and continuing to deal with that borrower. Now it seems like you can look at social media and find out what the creditworthiness of an organization. I'm exaggerating, but clearly we've had things like rating agencies and plenty of other things that have made the bank role less central. And we've also seen an increased ability to match assets and liabilities for investors. Aino was mentioning the importance of taking longer term funding and finding the appropriate places to put that in. That is important. And I'll caricature the argument a little bit, but there is a reasonable argument that private credit funds make that wouldn't it be really delightful if we could move corporate credit from the current system under which highly levered institutions, dramatically dependent on short-term funding, and that fall over so much at a natural basis that we have immense amounts of government support. Wouldn't it be nice if we could rely less on those banks and instead have, matched funding from organizations like insurers and pension funds that have longer term liabilities? I do think, especially some of the early moves in the private credit fund area were quite beneficial, creating this better matching. It's also had benefits for the borrowers, particularly if you're at the larger end of the SME spectrum. Private credit funds in the US have been significantly more accommodating. They've also tended to give better terms as well as the pricing. So there is definitely good stuff, as Aino was referring to earlier. But at the same time, as this sector is expanding and has been showing attractive returns, it's created the temptation to take significantly more risk. So you see risk in terms of who the funders are. So instead of this being pension and insurance money, it's increasingly, for example, wealthy individuals who maybe in theory have the ability to act as long-term holders, but often don't. And there's talk of bringing in retail investors through funds that would intermediate their money. So that's creating less stable investor bases. You see the credit funds moving towards riskier loans in order to expand the base of assets they can be in. there's been a lot of more complicated tranching and securitization type vehicles. Experts tell me it's not of the level of risk we had before the global financial crisis, but moving in that kind of direction. So again, my sense is we don't have a widespread problem yet, but we need to keep an eye on it. And I guess a final point I'd mention. Sorry, I was actually getting my notes here a little bit confused. So I'll leave it there.
Yeah, sure. Just to end on what you said about, growing risk in this sector. I mean, of course, banks have this sheer knowledge in terms of risk management, of assessing credit risk, in a very fine way. And I was curious whether you think that, in private credit, non-banks have also developed all this capacity to risk manage credit risk, okay, in the same way as banks did, because I think you're perfectly right that from the maturity perspective, there's a matching of horizons between, the long-term needs of financing needs of the economy, the non-banks. But it's really about, do we have this fine risk management, or do we have a movement whereby higher returns drive investment in an asset class that basically allows for having high profits on portfolios and stuff without having the adequate or proportionate increase in risk management.
I will say in terms of that, because it's a really good question that I and my colleagues at Oliver Wyman think about a lot. The problem is we don't know the answer, because the short version of the answer is certainly yes, it's both things happening. The more positive argument in terms of the private credit funds is, in fact, it's now become such an ugly thing to be a banker. We've been talking about regulation, but supervision has created immense compliance burdens and has blocked various activities. For instance, the Fed has been very discouraging of more levered loans, even in cases where many lenders actually think those loans are quite good. So you've had a migration of some of the better credit people to the non-banks. So there's at least a shot that they're actually better. Now, perhaps I was at JP Morgan for years, perhaps I hang out with bankers too much. I tend towards the other end of the spectrum of argument, which is more of what's going on is that we've had a period in which you could take more risk and make a lot of money, and that perhaps part of what we're seeing here is the winner's curse, that basically in an auction, the winning bid often overpays, or in this case, underprices its loans. And that maybe we'll find when the credit crunch really does come at some point, that we look back and see that banks, for whatever reason, regulation or their inherent skills, were appropriately more conservative on much of this, but many of the non-banks weren't. So I don't think we're going to know till afterwards, unfortunately.
Parag, you want to also opine on that?
Yeah, quite a bit there, but let me see if I can organize my thoughts a little bit. So I think one thing that I struggle with observationally is that suppose stronger regulation and higher costs, as Aino and Doug have mentioned, cause the shift of activity. What happens is that it also causes a shift of human capital. So suppose hedge funds that were inside banks leave. So let's say Goldman Sachs Asset Management is just no longer inside Goldman. Suppose it's outside. So of course, human capital shifts, and then it looks like, oh, bank is no longer equipped actually to do a certain kind of intermediation. And it looks like, oh, the outsiders now have an advantage because those who were skilled to perform a function also left. So the technology itself sort of moves. And then what happens is after 10 years, they of course say, okay, what we can do, banks can't. But to me, that's still sort of a migration that's happened. I think one issue where I do agree is that I do feel the world over the deposit franchise and this idea that they basically don't want to make equity investments makes banks very lazy. So banks are very slow to adapt to new technology. It's true in India. It's true in the US. You know, there's no reason why the US banks shouldn't have been at the forefront of fintech and digital and so on. They had all the resources to do it if they wanted to. But I think this sort of the cushion of stable deposits and the desire that creates to keep your equity investments low, I think makes banks lazy the world over. But then, of course, you know, it creates arbitrages for non-banks to come in. And I agree that if it's the laziness induced or underinvestment induced by the deposit franchise that's responsible for lack of innovation and intermediation, it's actually good to have a vibrant non-bank system that tries to chip away at that arbitrage created out there. I think the second important point Aino made, and I think this is probably maybe the deeper political economy issue, which is, okay, even if we recognize that there are pockets of non-banks that are systemically vulnerable, what can regulators do about it? How do you get the legal and the regulatory rights to actually gather the information, have some supervisory powers, maybe include them in stress tests, even if you cannot actually decide upfront what to do about it? Like, I would like to know in a stress test what happens to different parts of the non-banks before deciding whether they should be classified as systemically important or not. But if you can't do that exercise in the first place, how do you decide whether it's systemically important or not? And so I think this is a real challenge. And therefore, my sort of limited point at the end was that at least once we have extended a lender of last resort to a part of the non-bank system, maybe it's time to say they are systemically important. Because if not, why did we end up extending the lender of last resort to them? So I think the reason why I'm making this point is that I'm very uncomfortable with a little bit of a drive that is happening, which is that, oh, non-banks need liquidity. They are important. And so the central bank should start creating standing repo facilities for them. And I'm like, no, you can't do that. You can't give a public backstop to an entity without actually getting rights to know what they're going to use that backstop for. You know, the carrot and the stick should really go hand in hand. And so I wish that sometimes, so I think we are very quickly to extend backstop to entities by saying they might need liquidity, it's going to cost the real economy. But I think the whole idea of banking was you give them a license, it comes with some privileges, and then it comes with some restrictions. And I think sometimes in the non-bank space, we are losing that perspective, in my view. So I'll stop there on the legal and regulatory points. I think Doug raises a very important point, that is it now the case that a lot of lending can just be done by non-banks? And I think it might be true. And actually, once again, if I go back to the banking theory of credit lines, that theory, unlike the delegated monitor theory, actually would say that the unique advantage that a bank has is access to deposit franchise and the public backstop. What it allows them to do well is to manage liquidity risk for the economy. A term loan is technically not that different from a bond, a fixed maturity bond, and that perhaps banks should not have a privilege actually in making term loans. The nuance there is that, however, even if someone gets a bond from the markets, they will still get a credit line from the banks. Credit line is an insurance, just like you have the typical insurance moral hazard. A bank is always worried about a credit line being drawn down in the worst possible scenario. So they put in covenants, they monitor the borrowers. That monitoring creates inside information in the bank, And now you could start getting some synergies as to, okay, maybe they have some information in making loans that outsiders don't, because they are not providing insurances and therefore doing all this monitoring to covenants, etc. So that's my only limited point, which is that, and I think you observe this, like small businesses, at the end of the day, okay, fintech may give them a term loan, they still get their business credit cards from banks. They don't get business credit cards from fintechs. Maybe if they start getting Fed backstops, maybe they can also start providing it. And the second important point Doug made, which is, I don't have a good answer to that. I've been scratching my head quite a bit on that, which is the private credit capital structure in which there is so much equity to make the loans, relatively risky loans, but there's still a lot of equity. It clearly looks better from a solvency standpoint, that they can absorb a lot of losses. Is that a better way to organize credit in the economy than the historical banking one? And I just have two thoughts. One, maybe we have to wait until a significant corporate recession takes place. I think we have not yet seen that. Maybe we have to see how stable they are. And the academic work on that, especially on business development companies, the view it's taking is that essentially their cost of capital is very attractive because they are able to get investment grade bonds being held by insurance companies. And their view, therefore, is that actually it's not a failure of the private credit, which is going to be the beginning of stress. It's going to be the lack of being able to issue investment grade paper. That the moment they can't issue investment grade paper, actually there'll be a steep increase in the cost of bonds that they have to issue, and they will immediately start passing that on to the end borrowers. And so just 2 points, therefore, which is that maybe some of them do look safe, but I would feel a lot more confident after the next crisis or at least a next corporate recession has happened. As of now, we don't seem to be allowing corporates to fail. we seem to quickly get into accommodation mode, etc. So we have to wait and see. Okay, why don't I stop here?
Thanks, Viral. We have 5 minutes for questions.
Yeah.
Some of them you already answered, actually, I think. Vanessa's question that everybody can read, and also Yannick's question. But let's go to two that I think we haven't answered. Jose is asking to what extent higher capital requirements for bank loans to NBFIs could be an appropriate regulatory tool. And one of you may want to take that over. Is it that simple, increasing capital requirements on loans to NBFIs?
No, of course it's not that simple. The risk weights which determine the capital should be based on the level of risk. The different NBFIs are doing quite different things, have different capital structures, etc. Maybe taking a simpler version of the argument, maybe it's all systematically too low, but that's not at all obvious to me. I mean, Viral has talked about the continuing connections, but there's been less emphasis on the fact that continuing connections are almost exclusively in ways that reduce the level of risk the bank is taking, as opposed to the direct lending that they were doing before. So I don't know. I mean, others could have different views, quite obviously.
Yeah, if I could just jump in. Yeah, I agree. The most promising approach I find is that I don't think we are likely to get legal and regulatory powers over NBFIs that easily. So I like the idea that if at all you do something, you do it through the banking system. But I think we have to really think about the banking system in the stress scenario. And one reason why I wanted to show those 3 lines of the drawdowns is that the credit lines, for instance, behave very differently between real corporations, the average NBFI, and some segments of NBFIs like the REITs. The utilization patterns are very different. A good policy would recognize some of this heterogeneity, do the research, then build it into the stress scenario, and correspondingly adjust the capital weight. So when a drawdown occurs on a credit line, what was a low capital requirement of balance sheet liability becomes now an on-balance sheet loan. Okay, it can be repaid early compared to a term loan, but it's now an on-balance sheet exposure. So there's going to be an increase in the capital requirement when the drawdown occurs. In a stress scenario, banks are typically tight on capital, so you do want, therefore, to hold a higher buffer. Now, if you do this right, then banks will figure out how to pass on the costs to the various NBFIs. But I agree that you have to respect the heterogeneity, otherwise you'll get other sorts of arbitrages happening, and then you may be even making capital too costly for certain parts that don't deserve it to be so costly, and so on.
So I know, unless you want to add a word, I will hand over to Ernest to conclude.
There were some really good points there made in the end, and I think definitely I would just like to agree on Viral's point that at least if we're providing a liquidity backstop, that's a reason to expose, at least do something about some of these issues, because it might be really difficult to find out everything ex ante, but to deal, I think we have some known problems that we could deal with as well.
This concludes our SUERF-BAFFI Bocconi webinar on where do banks end and NBFIs begin. Thank you, Viral, Aino, Doug, Imène, and Martin, for sharing your views and insights with us and your time, and to all participants for your interest and your many questions. Bye-bye and take care. Thank you so much.
Bye-bye.
Thank you very much.
Thank you so much, Amin, Aino, and Doug. Very kind of you. Thank you. Bye.